All right, the main event here for investors, the U.S. is a little more than a week away from defaulting on its debt, which economists fear could have seismic implications in the global economy and for your money. Let's bring in Doug Flynn, partner and co-founder at Flynn Zito Capital Management, to discuss how it could affect your personal investments. Good morning, Doug. Nice to see you.
Good morning, Christine. How are you?
I'm fine. I'm wondering if we should just be forgetting the login to our 401k and just living through this, or if we need to be taking a look here and getting a little more conservative. Walk us through what you think the possible scenarios are here.
Yeah, there's a couple. One is whether this is going to be whether or not they're going to default, and whether it's going to be a long-term one or a short-term one. And a short-term one, you can take your cues from what happened in 2011. The market's going to correct, but it will kind of work its way through and then sort of bounce back. But the real concern is whether or not it's going to be long and protracted. That is where you get some unprecedented downturns. Really, the market could tank more than 40%. So the issue with your 401k is, don't stop that because you're saving weekly. But when it comes to maybe cash, your cash is going to become king. Gold will do well. There'll be pieces that do well in sort of that market where everything is in free fall, because the safest place in the world is now not the safest any longer, per se.
The 2011 scenario, the S&P went down, I think, 17%, 15 or 17% over a couple of months. So that was a buying opportunity for investors. You didn't want to jump out of the market there. You wanted to just kind of close your eyes and ride that. But this other scenario, this 40% scenario you're talking about, if things get really ugly, that concerns me. What if you have a kid, you have a 529, you've got money in there for a kid, and you're still fully invested in stocks for a kid that's going to graduate in a year or so? Maybe you should lighten up?
Yeah, well, anytime you're less than 3 years away, you should already be lightening up your equities, your money in the market. When you're within 1 year with yields in money markets and savings now pushing 5%, you don't need the stock market risk for anything less than a year. So I would say the pause that's going on right now in the market is a great time to look at money you definitely need in the next year. Of course, if you don't need money for a long time, that will become another buying opportunity, but other things will do well. You have to think about stocks like utilities, where people still need to put the lights on.
Right.
Real estate could hold up, gold, and then using that cash, if you have it, to then pick off some things that maybe got away from you that you wanted to buy but got too expensive. Those will be down a lot. That's your opportunity, even though it's going to be hard to do it at that time in a long-term protracted negotiation.
Let's take a look at the calendar. We got a little more than a week out from a potential default. I'm wondering, what are your clients asking you about? Are they calling you, asking you if they should be making any changes because of what's happening in Washington, or are they numb to this? I mean, we've been here before, 2011, 2013, again today.
Yeah, I always say that no administration or Congress wants to be the one that the U.S. defaulted under. That has never happened, and that will be with them. And the American people are going to vote with their money and their feet with that if they let this happen. So it's not the base case that it's going to happen, but realistically, you really have to look at if that does happen, how to take advantage of it, and with things like, we think it's going to get resolved. And if it does get resolved, then you might have a relief rally. And so the fear is, if you take your money out of the market, you're going to miss that relief rally if the talks that they're doing come through and they settle this. So I don't think the risk is worth going in the market for the possible pop you might get versus the downside risk if they don't at this point.
All right. Doug Flynn, always nice to see you. Thank you for calm and reason. And I have to make a tweak to my 529 for my oldest kid. Thank you. Thank you so much, Doug. Nice to see you.